Today is the last trading day of the Biden administration. Then we get a long weekend in the United States. We get the inauguration and Trump takes over. How much risk is there for markets between now and then?
Between now and then, very little. But when Trump obviously takes power, I think there's a potential for immense moves. We've been having this debate recently because obviously previously you would not really have cared about inauguration days. Even in Trump's first presidency, this was not a big market mover. But he has vowed to sign many executive orders in the first day, potentially hundreds, according to some people out there. Now, it's what he signs. There's just a massive dispersion of views. And that means it's quite interesting. Even theoretically, if Trump took no executive orders in the first day, that would actually be market moving right now because there is so much of the market that have big expectations for what he might deliver. But so the range of expectations out there is massive, which means whatever happens on Monday afternoon in the US, Tuesday morning in Asia is going to be market moving. It is going to be a volatile start to the week. Now, whether it continues being volatile depends on what is ultimately delivered or not.
The S&P is up about 56% during Biden's term, 4 years. So we'll see if Trump can best that when he takes over, of course, the helm from Monday, Tuesday. Mark, when it comes to the China data, the markets seem to kind of look through it. The GDP number hit the target. There's some big challenges still, particularly on real estate, particularly the demographics of China.
Yeah, the China story has not really changed. Today, the data was very good, and I thought it was interesting that no one wanted to care about it because it was very good. It would have been a much more talked about story if it was really, really negative data. We know that the China story is structurally very problematic. They're not going to, the real estate story is going to be one that's going to take years to turn around. They're not going to fix that quickly. I am in the camp, and that's a very small camp, that believes that the government has got the message and they're taking major steps and that they have stabilized the situation, that the market will do better this year as a result. That does not mean it's a structural bullish story suddenly. It does not mean the economy is suddenly going to run away in a very strong performance. What it means is that markets can do slightly better this year because the government realizes the problem and is doing what is necessary to stabilize, not get a big new bull market.
Sales selling this morning. Retail sales was weak.
Yeah, look, the data out of the UK is just absolutely terrible at the moment. Yes, sterling should probably suffer because the data has been so poor this week. And I think what's going to happen actually is that, while obviously this increases rate cut bets from the Bank of England, sees front-end yields lower, I'm not so sure that long-end gilts do well out of this. I think that the data has been so poor, it's problematic for the government's budget plans, which again sees maybe more pressure come in on long-end gilts later on after we process this data. So this is probably going to be yield curve steepening. And ultimately, that stress on the UK bond market isn't going away, which means stress on the sterling is not going away either.
Yeah. So the cut being almost fully priced in for the Bank of England for February, 92%.
But the market's still only around 2. The bank's around 4. You've now got members of the MPs. 67 basis so we're just north of 2.
Yeah.
The bank's signalling 4. Taylor, I think, was signalling 6. So the gap between the market and where the bank potentially could be getting wider. You could argue, like, if we get north of 50, that maybe we're beginning to close that gap. But certain dovish members are now beginning to push north of 4 in terms of what expectations look like.
Mark, where do you think the BOE should land on this? I mean, Blue Bay Asset Management, Mark Dowding was telling us that inflation is going to get worse from here for the UK. Does that constrain a Bank of England, or does their focus now shift to what you say is the terrible data of this economy?
The inflation data absolutely could constrain the Bank of England. I think the way you've got to look at this is in a relative value play to the rest of the world. Back in November, we talked about the need to kind of tighten in the rates divergence between the Bank of England and the US. We've seen some of that. But I still think the fact is that we're pricing in, a really sustained divergence in yields between, say, for example, Europe and the UK. And I think that's not likely next year. Now, it is hard to know what Trump's going to deliver next week. And that's going to really play into the global inflation story, the global growth story, the global trade story. Everything is going to be changed by what he delivers over the coming weeks. And that means rather than having an outright view on the Bank of England pricing, I prefer to kind of say that I think that Bank of England, the rates pricing path in the Bank of England will end out converging a little bit closer to Europe over the next year. I'm not saying it's going to close that gap entirely. So either that might be a world where, European rates need to go higher, or it's a world where UK rates go much lower to get back down to Europe. But having an outright view in any country at the moment is hard before next week.